The conference room is silent except for the clicking of a projector. On the screen, a man in a black turtleneck stands beneath the logo of a revolutionary blood testing company valued at $9 billion. Investors applaud. Politicians praise her. Television anchors call her the next Steve Jobs. Employees inside the company whisper a different story. The machines barely work. Test results are unreliable. Some patients are receiving incorrect diagnoses for cancer, pregnancy complications, even HIV. Yet the money keeps flowing. Across the world, an elderly retiree receives a phone call. In another city, a student watches a cryptocurrency chart explode upward while influencers promise freedom. Different scams, different victims, different eras, but underneath them all sits the same invisible architecture. Trust weaponized as a financial instrument. The modern economy runs on abstractions, numbers on screens, digital promises, contracts most people never read. The first scam begins in Boston in 1919. A small office on School Street fills with investors carrying cash and life insurance payouts. At the center sits Charles Ponzi. He speaks softly, dresses sharply, and offers something impossible: 50% returns in 45 days. Ponzi claims he has discovered an arbitrage opportunity involving international postal reply coupons. To ordinary investors, the explanation feels sophisticated, global, mathematical, modern. Imagine drawing 3 circles. The first circle contains new investors. The second contains promised profits. The third contains older investors waiting for payouts. In Ponzi's system, no productive activity exists. New money simply moves in a circle. Funds from new investors pay fake returns to earlier investors. The entire system collapses within weeks. Investors lose fortunes. Banks fail. Families disintegrate financially. Charles Ponzi is arrested, but the blueprint survives him. In 2008, authorities arrest Bernie Madoff. Estimated losses exceed $65 billion. Madoff does not promise absurd returns. He offers consistent, steady gains. The circular machinery breaks during the 2008 financial crisis. It can survive skepticism. It cannot survive liquidity pressure. During the cryptocurrency boom of 2021, decentralized finance platforms promise yields of 20%. The terminology changes to staking rewards, but the psychology remains identical. So, how do you protect yourself? First, separate complexity from legitimacy. Complex explanations are not evidence. In fact, excessive complexity often functions as camouflage. Second, examine the source of returns. Third, distrust consistency in volatile environments. Real markets fluctuate. Artificial smoothness can signal manipulation. The people most vulnerable to sophisticated scams are often intelligent and successful because scammers target trust, not stupidity. In November 2022, employees inside FTX begin realizing something is catastrophically wrong. Customers are requesting withdrawals. Billions of dollars appear missing. Executives scramble internally while the founder continues posting reassuring messages online. For years, he has cultivated the image of a mathematical genius. Politicians court him. Celebrities endorse the platform. Venture capital firms compete for access. Then the balance sheet leaks. Suddenly, one of the largest cryptocurrency exchanges looks less like a revolutionary institution and more like a fragile shell held together by a reputation. The collapse happens with astonishing speed. Within days, the company files for bankruptcy. Millions of customers lose access to funds. But the real significance is the exposure of a modern financial pattern where charisma substitutes for transparency. The industries claiming to disrupt finance often recreate historical failures. Imagine a diagram. At the bottom sits speculative enthusiasm. Above it sits liquidity, easy money flowing during periods of low interest rates. Above that sits narrative acceleration powered by social media and celebrity endorsement. At the top sits valuation. Now remove one key component, rigorous verification. Confidence behaves differently from fundamentals. Fundamentals deteriorate gradually. Confidence collapses instantly. Scams appear stable until the exact moment they disintegrate. How do you protect yourself? Start by separating product utility from investment quality. A technology can be useful while still being fraudulently managed. Second, examine governance structures. Who controls customer funds? Third, distrust cultures built around personality worship. Institutional accountability weakens when inseparable from a founder. The fourth scam targets ordinary people trying to survive. In 2007, families sit at kitchen tables signing mortgage documents they barely understand. Banks package loans into securities sold globally. The machine appears unstoppable. But buried inside is a quiet structural deception. Obligations, misaligned with repayment ability. Traditionally, lenders absorb losses if a borrower defaulted. Securitization changes the equation. Risk becomes dispersed globally, and lenders no longer bear the consequences. The mechanism resembles a pipeline. At every stage, someone earns short-term revenue. At almost no stage does anyone fully retain long-term accountability. Then, the catalyst arrives. Housing prices stop climbing. Borrowers cannot refinance. Mortgage-backed securities lose value. Banks face massive losses and credit markets freeze. Today, similar patterns appear in private credit and crypto lending. Financial engineering still prioritizes short-term yield over long-term resilience, transforming obligations into tradable abstractions. The fifth scam is manufactured urgency. From the Dutch tulip mania to internet startups and meme stocks, different assets follow the same emotional engine. Rising prices generate media attention, which attracts new participants. This creates a feedback spiral where people mistake momentum for inevitability. But once sentiment shifts, liquidity evaporates. Participants discover there are far fewer exit opportunities than assumed. Financial history repeats because human psychology repeats. Modern version spreads faster because digital platforms compress time. Trends that once took years now emerge within days as viral narratives overpower analysis. The most effective defense is literacy. Understand incentives. Follow the flow of money. Separate complexity from legitimacy. Interrogate urgency. Confidence moves markets faster than truth. Understanding that architecture will allow you to see the hidden plumbing beneath the promises and protect yourself.